Let's imagine my dividend portfolio only have REITs. Let's say I've got 100% REITs in there. Then 2022, I die, okay?
Let's kickstart the discussion. What are some lesser known secrets or hacks, especially for somebody that is just starting about their dividend investing journey? Maybe you can share.
I think the first thing is that a lot of people, when they look at dividend assets, they focus just on the yield, the starting yield, right? Whether 5, 6, or 7%. And that's a mistake. But more importantly, you have to look at the growth of the dividends that they're paying out. Okay. And let me give you an example. So if you have a stock that has a starting dividend yield of 3%, you may say it's only 3%, right? But if the dividends are growing at 20%, then every year you get more and more dividends. You find that in 5 years, the 3% starting yield will become 7.5% yield. And that's better than another stock where you get a high starting yield of maybe 7% starting yield, but the dividends are not growing or the dividends are declining. So I think that's one of the most important things, to look at both attractive yield, starting yield, and the growth of the dividends. So for me, I like to look at both. Ideally, personally for me, I like to look at stocks with a starting yield of at least 5% and again the growth in the dividends. So one of the best investments I've made is actually in DBS Bank, listed in Singapore. When I bought it many years ago, the starting yield was actually about 5.5%, but their dividends grow about 12% or more a year on average. So that means that in 5 years, my actual yield on the cost which I invested is about 9.7%, almost 10%, right? And in 10 years, about 17%. So when people ask me, Adam, right now the DBS shares that you own, what is the dividend yield you're getting? Well, based on the cost that I went in, it's like 15-20% yield, which is fantastic.
Actually, is there a reason why it seems like 5% is like the magic number on why people look at on a yield on a portfolio basis?
There's no magic number and it changes. It all depends on the prevailing interest rate. If you put your money in the bank right now, you're getting what, 1.3%? So I would say that based on that, getting a 5% yield on a high quality dividend stock is reasonably attractive. But let's say, for example, like in 2022, when interest rates were very high and you put your money in the bank, you could get 3.6%. Then a 5% yield is no longer attractive, right? So if the bank is giving you 3.6% already, then an attractive yield would then be maybe about 7%. So it's all relative to the interest you're getting in the bank.
Right. So the relationship here is
You want a premium. You want to get a premium above the bank interest rate. Yeah.
relative to, like, let's say the risk-free rate per se.
Relative to the risk-free rate.
Because I wanted to have this conversation, right? I think pre-2020, we were in an ultra low interest rate environment.
You get less than 1% in the bank. Yeah.
So back then, a lot of people were chasing yield products that they're okay with 3% because comparatively less than 1%.
Yeah, so in those days, when the interest you get from the bank was less than 1%, then a 4% yield would be very attractive, really. Right? 3.5 to 4% was attractive at that time.
So is it kind of safe to say that right now, because we look at a lot of the products in the landscape, right, they're offering 5, 6, sometimes pushing to nearer to 10%. Should we, in that case, try to, as quickly as possible, try to lock in our yields? Because now we tend to be at the higher interest rate levels, and then we are expecting rates to come down so that naturally the premiums will all get shrinked up.
Yeah, in a way, yeah. You want to lock in those good yields, but of course only in assets where the dividends themselves are growing. That's really important.
Maybe just to move on to a second discussion, right? We have this constant back and forth about high yield versus low yield and whether it's the relationship with risk as well. I think based on our conversations as well, I heard that you are invested in different yielding products. So you have from the very safe ones, which is bonds, all the way to, let's say, private credit that is offering maybe high single digit yield. And the general consensus or thinking around when you look at the yield itself is that the higher the yield, the riskier the product. So maybe you can share a little bit more in terms of your thought process on why private credit, why are they able to offer such a high rate, and are they really a lot riskier compared to, like, let's say, dividend stocks or bonds?
So generally, the school of thought is that when something has a higher yield, it's more risky. Okay, so generally that is true generally, but it's not always the case. It depends on the individual asset itself. So give you an example. So a lot of people will say that bonds are safer than stocks, for example. Is that true? Not really. So if you buy a bond of a company that has got too much debt, or you buy a bond of a company that's very cyclical, or you buy a bond of a company that doesn't have consistent profits, then it's very risky. Now remember High-Flux or Lehman Brothers. When the banks were selling the bonds of Lehman Brothers and High-Flux, they say, oh, it's very safe, right? Because the concept was safe. But what happened? These bonds went to zero. Because at the time, if you look at High-Flux, their free cash flow was negative. The debt levels were very, very high. So in that case, the bond is very, very risky because it's of a low quality company. But then if you buy the stock of a high quality company like DBS and you buy the stock for a dividend, then it's safer. All right. So a stock can be safer than a bond if it's a high quality stock and low quality bond. All right. So private credit. If you buy a private credit fund, you can buy listed ones or non-listed ones, right? The average yield is about 8 to 10%. So initially, when people look at it, 8 to 10% yield must be very risky. And that's what I thought initially when I looked at it. I said, cannot be so good, right? But when I did a lot of research, I found that yes, there are some private credit funds which I bought that to me are very low risk, to me are very safe and give 8 to 9% yield. And in fact, they are safer than bonds that give a 4% yield. Bonds are rated based on credit rating, right? AAA, AA, and stuff like that. Let me put it this way. I don't really trust rating agencies, okay? So again, remember that there was once upon a time when High-Flux and even Lehman Brothers were rated quite high, but they went to zero. Because if you study the business, you know that something's wrong. Too much debt and negative cash flow, right? Now, private credit funds, they appear risky because they are unrated. But if you study their business model, you realize a few things. Okay, number one, the high quality private credit funds, over 90% of their loans are first lien senior secured loans. So what does that mean? That means when they lend money to companies, and if the companies are in trouble, they've got the first claim on the companies and they are secured. That means they are collateralized. But a lot of the bonds that you buy, which are even AA or AAA, they are not collateralized. That means the company go bust, you get nothing. But for private credit, they are collateralized. So the collateral could be a property or stuff like that. And if you actually study the high quality private credit BDCs, you find that they are non-accrual rates. What does that mean? That means when they lend money to the borrower and borrower doesn't pay on time, it's a non-accrual. And I buy the ones where the non-accrual rates are very low. It's like 0.3%, for example. And there's another thing called the loss ratio, which are companies they lend to that in the end never pay back. So you always want to make sure that the loss ratio is less than 2%. Now, most of the private credit funds I buy, the loss ratio is like less than 1%. Right? And they are very well diversified. So they are perceived to be risky, but if you actually do your research into the high quality ones, to me, they are less risky than the bonds. So what I found in my own research and my own investing is this, that I could invest in an asset that gives me a 9 to 10% yield that is low risk compared to a bond that gives me 3 to 4% but is high risk. So if you want to find out more about how I analyze bonds, how I analyze private credit to buy the highest quality ones, then you can check out my income investor course that I've created. It's an on-demand course, watch anytime, anywhere, lifetime access. And in the course, I explain in depth my criteria of how I select, again, the highest quality income assets, whether bonds or private credit or dividend stocks, to build a resilient, bulletproof portfolio.
Actually, on this note as well, Adam, I think through our discussions, we talked about, let's say, private credit, investing in dividend stocks, investing in strong REIT companies, real estates, you even have bonds. So while building out this entire portfolio, how do you structure or how do you think about in terms of portfolio diversification? And is it really a need? Can't I just let's say I want to build an income portfolio, I just buy the banks, or in that case, because you tell me they are strong companies, can I just buy the 3 local banks and then call it a day? Would that be fine?
It's not wrong. You could do that. But why I like to diversify? So again, in my portfolio, you find that I've got a certain balance between dividend stocks, which include a lot of the Singapore banks. I've got REITs, I've got private credit, I've got bonds. So why do I have all 4? Because they all perform differently in different macroeconomic environments. Okay? So let me give you an example. Let's imagine my dividend portfolio only have REITs. Let's say I've got 100% REITs in there. Then 2022, I die. Okay. Well, not that I die, but my portfolio will see a very big drop. Because in 2022, when the Fed raised interest rates aggressively, REITs share price will drop a lot. Why? Because REITs, they use a lot of leverage, they use a lot of debt. All right. So when interest rates go up, their interest expense go up, their profits drop, they pay less dividends. But because my portfolio, I also have banks, Singapore banks, and I got private credit. When interest rates are high, REITs go down, but banks do very well. Banks do very well in high interest rate environments. Private credit does very well. In the end, what happens? It balances off, all right? And now the interest rates are coming down, you find that the banks are still doing well, but not going up as much as they were. Private credit has been moderating a bit, but now REITs are rebounding. So you always want that balance. Yeah, so like anything else, remember that the key to successful investing is not predicting the market. People always think, oh, I can predict when is the next recession, I can predict where the market is going. No one can predict for sure. Even I can't predict after doing this for 30 years, right? But to be a successful investor, it's not about predicting the market. It's about building a portfolio that is resilient, that is weatherproof, that can do well in all environments. So I don't care whether interest rates go up or they go down. I don't care whether we have a recession or no recession. I don't care. You know why? Because the way I build my portfolio is my portfolio will do well in any situation. Like for example, why do I also have some bonds? Now, among all the different income assets, some people say, but bonds are not as good because the interest is fixed. It doesn't grow. It's a fixed coupon, right? But bonds have one advantage. They do well in recessions. So if we happen to have a recession coming, which I don't know if we will, I can't predict, but if there's a recession coming, then the bonds will do very well and they will offset the drop in the bank stocks. So you gotta have that balance.
So with that, I hope you enjoyed the discussion and we'll see you in the next video. Till next time, keep winning.